Two friends, same college, same starting salary, same city. 10 years later, one of them owns a house, has no debt, and barely worries about money. The other one still checks his bank balance before ordering food, same income, same years, same opportunities. So what actually happened? It wasn't luck. It wasn't a secret job. It wasn't even how much they earned. It was something so small, so boring, that neither of them even noticed it happening. And by the end of this video, you're going to see exactly what that thing is, and why almost nobody talks about it the right way. Let's start with the biggest myth about the stock market. The one that stops most people before they even begin. Most people believe the stock market is something like gambling. You put money in, prices go up and down, and if you're lucky, you win. If you're unlucky, you lose everything. So what do most people do? They stay away completely. They keep their money in a savings account, feeling safe, feeling responsible, while their money quietly loses value every single year because of something called inflation, prices going up while their savings just sit there, frozen in time. Here's the strange part. The people who avoid the stock market because they think it's too risky often end up in a much riskier position than the people who invest. Because doing nothing with your money isn't actually safe. It just feels safe. That feeling is the first trap, and the second trap is the opposite one. Some people do jump into the stock market, but for the wrong reason. They see a video of someone who doubled their money in a month. They hear a friend talk about some stock that exploded, and suddenly they think investing means finding the next big win, buying at the right moment, and selling before it crashes. So they start checking prices every day, buying when it goes up because they're excited, selling when it goes down because they're scared. And after a year of this, they usually end up with less money than when they started. And a story about how the stock market is rigged. It's not rigged. They just played the wrong game. There are actually two games happening in the stock market at the same time, and almost everyone gets confused about which one they're playing. Let's break this down in the simplest way possible. Imagine the stock market is a giant vegetable market, and instead of vegetables, people are buying and selling tiny pieces of real businesses. When you buy a stock, you're not buying a lottery ticket. You're buying a small ownership slice of an actual company, a company that sells products, earns money, and hopefully grows bigger over time. If the business grows, the tiny piece you own becomes more valuable. That's it. That's the whole idea at its core. Now here's where it gets interesting. On any single day, the price of that tiny piece can jump around for all kinds of emotional reasons. News headlines, fear, excitement, rumors. On a short time scale, the stock market behaves like a mood ring. It reacts to feelings. But over a long time scale, years, not days, the price tends to follow something much more boring and much more reliable: how well the actual business is doing. This is the first game. Reacting to daily price movements, trying to predict short-term mood swings. This game is called trading, and it's incredibly difficult. Even professionals with years of experience struggle to win at it consistently. The second game is completely different. It's not about predicting what happens tomorrow. It's about owning small pieces of good businesses and simply allowing time to do the work. This is called investing, and ironically, it's far easier, but it feels much less exciting, which is exactly why most people skip right past it. Now let's talk about the real engine behind wealth building, because this is where the magic actually happens, and it has almost nothing to do with picking the right stock. Imagine you plant a single seed. In year 1, it's just a small sprout, nothing impressive. You might even forget it's there. By year 5, it's a small tree. By year 20, it's massive, tall enough to give shade to an entire family. The seed didn't get smarter. Nobody watered it with some secret formula. It simply had time, and it grew on top of what it already grew the year before. This is exactly how money grows in the stock market, through something called compounding. Your money earns growth. Then, next year, you earn growth on your original money and on the growth you already made. Then the year after that, you earn growth on all of it again. In the beginning, this looks incredibly slow, almost embarrassingly slow. If you invest a small amount after 1 year, it might grow by an amount that barely buys you a nice dinner. People see this and think, this is pointless. It's not even doing anything. But here's the part nobody shows you. Compounding isn't a straight line. It's a curve that stays flat for a long time, and then suddenly bends upward faster and faster. Let's make this real with two people. Person A starts investing a small, steady amount every single month starting at age 25. Nothing dramatic, just consistent. Person B waits. He wants to figure things out first. He wants to save up a bigger amount so he can start seriously. He finally starts at age 35, investing double what Person A puts in every month, trying to catch up. Here's the uncomfortable truth. By the time they both reach 50, Person A, who started 10 years earlier with less money each month, ends up with significantly more than Person B, even though Person B invested more money overall. The difference wasn't how much money they had, it was time. Person A gave their money a longer runway to compound. Person B was racing against a head start he could never fully close. This is why financial experts often say something that sounds almost like a joke, but is actually deadly serious. The best time to start investing was years ago. The second best time is today. Now here's the deeper insight, the one most people never truly understand, even after they start investing. Growing money in the stock market is not primarily a financial skill, it's a psychological one. Think about it. The stock market doesn't ask you to be a genius. It doesn't require you to predict the future. What it actually tests is something much harder: your ability to stay calm while doing nothing. Here's a strange truth about the human brain. We are wired to react. When something drops in value, our brain screams, "Protect yourself, get out now." When something is rising fast, our brain screams, "Jump in before you miss it." This wiring helped our ancestors survive physical danger. But in the world of investing, this same wiring becomes our biggest enemy. Picture this. The market drops 10% in a week because of some scary headline. Person A panics, sells everything, and puts the money back into a savings account, relieved to feel safe again. 6 months later, the market has fully recovered and grown further. Person A missed the entire recovery because fear made the decision for them, not logic. Meanwhile, Person B saw the same drop, felt the same fear, but simply did nothing. They kept investing the same small amount every month, drop or no drop. A year later, their patience turned that scary dip into one of the best buying periods of their entire investing journey. This is the part almost nobody tells you clearly. The stock market doesn't reward the smartest people. It rewards the most patient and consistent ones. Boring, unglamorous, repeated action beats emotional, reactive decision-making almost every single time. There's actually a well-known finding from financial researchers that proves this. When they studied real investor accounts, the people who completely forgot they even had an investment account, because they moved, changed jobs, or simply lost track, often ended up with better returns than people who checked and adjusted their investments constantly. Doing less, ironically, often performs better than doing more. Let that sink in for a moment. The winning strategy isn't found in some secret trading trick. It's found in your ability to not touch something, even when your emotions are screaming at you to. So what does this actually mean for you, practically? First, stop waiting for the right time to start. There is no perfect moment where everything feels safe and certain. Waiting for certainty is often just fear wearing a disguise. Starting small today beats starting big someday that never comes. Second, treat investing like a habit, not an event. The goal isn't to make one brilliant decision. The goal is to build a repeated, boring routine, investing a set amount regularly, the same way you'd pay a bill, regardless of what the market is doing that week. Third, protect yourself from your own emotions. Decide your plan when you're calm, and refuse to make investing decisions when you're scared or excited. Those are exactly the moments your brain is least reliable. Fourth, think in decades, not headlines. A single news story will not determine your financial future. 10 years of consistent, unemotional investing will. And finally, understand that growing money isn't about finding a shortcut. It's about becoming the kind of person who can stay patient while everyone else is panicking or getting greedy. That patience, more than any stock pick, is the real skill being built here. So let's go back to those two friends from the beginning. The one who quietly built wealth didn't have secret knowledge. He didn't predict the market. He didn't get lucky with one stock. He simply started early, kept going when it felt boring, and refused to panic when things looked scary. The other friend was waiting, for more money, for more certainty, for the right moment. And that moment never arrived because it doesn't actually exist. It's a story our fear tells us to keep us safe from doing anything at all. The stock market isn't really testing your intelligence. It's testing your patience, your consistency, and your ability to sit still while your emotions try to talk you out of it. So the real question isn't, how do I find the perfect stock? It's this: are you willing to start small, stay consistent, and let time do what it does best? Because in the end, wealth isn't built in dramatic, exciting moments. It's built quietly, one boring month at a time.